Hi, everybody. Today we have Michael Scott with us again. My name is Rainah Fitzgerald. Michael recently did an article on our quarter update from the end of 2022, and him and Mackenzie sat down and did an interview for that. So if you haven't watched it or read the article yet, please go do that. Stay informed with us. We today are going to talk about another article that Michael's done. Michael's just been writing all kinds of stuff lately. But Michael did an article on the Secure Act 2.0. So Michael and I talked a little bit about this, but obviously that hints at the fact that there was a Secure Act 1.0, right? So Michael, I'd like to first ask, can you explain to us what the Secure Act is?
Yeah, Raina, it's kind of cool doing one of these and not just talking about investments, right? I think
Yes.
those are generally where most of our conversations are around. But this was kind of a really monumental piece of legislation that just kind of snuck in under the radar back in December. But the Secure Act 1.0 was a piece of legislation that President Trump signed into law at the end of 2019. And it was basically an update and a refresher to a lot of retirement plans, whether that be IRAs, 401ks, 403bs. There was a lot of updates that were done, and a lot of positive things came about out of that, and kind of had bipartisan support. But one of the things that did occur were some updates and some changes that needed to occur, and there was a lot of input across the aisle on different ways to improve it, and it kind of led the path down to where we're at now, where we have a Secure Act 2.0.
Okay, cool. Well, now that we know there's a second part to this and a little bit more about what the Secure Act is, can you talk a little bit more about the 2.0 and what the changes and updates that have been made?
Yeah, and by no means is this an exhaustive list. I think we're going to learn more about Secure Act 2.0 over the coming years. This was passed at the end of 2022 as part of the omnibus spending bill. I think everyone focused on the $1.7 trillion spending tag, slid into this as well with Secure Act 2.0. And one of the major things that is being changed in Secure Act 2.0 is RMD ages. So I know you and I have talked about this over the years of processing RMDs. Prior to 2019, you had to take an RMD at age 70 and a half. Secure Act 1.0 changed that to 72 and a half. Secure Act 2.0 takes that one step forward and says that now, for those that are going to turn age 73 in 2023, so if you're turning age 73 starting January 1, that is when you have to begin taking RMDs. So that age went from 72 to 73. Additionally, it also has a provision in it that 10 years out, so in 2033, that age is going to go up to 75. And then we'll probably readdress that down the line as well. And I apologize going back and forth here. There's a list of different things going on. Another really important piece is that taking RMDs can be messy and it can be confusing. And a lot of times, investors, especially when it's their first year, they may make a mistake and not realize that they have to take one. And that used to come with a nasty penalty. It used to be about 50% of what you failed to take was a penalty. That number has dropped down to 25%, and the penalty will actually further decrease down to 10% if you file an amended return and move forward. So that's a really cool thing for many investors and many savers. And then finally, here, there's some changes to workforce plans, whether they are 401ks, 403bs. There's some different changes going on here. One really interesting change is centers around catch-up contributions. So for those of us that are listening that are age 50 and older, we are entitled to make catch-up contributions. That number is going to increase if you are between the ages of 60 and 63. You can do 10,000 a year. So backing this up for year 2023, anyone under the age of 50 can put in $22,500. Um, this year, you can do a catch up contribution if you are above the age of 50, and you can put in an extra 7,500. Beginning in year 2025, if you are between the ages of 60 and 63, you are able to put in an additional 2,500, which makes your catch-up contribution go up to 10,000. So as we live longer, as we work longer, we'll be able to put more monies into our retirement plans. Now, with every great benefit, there's always a catch, right? And the catch here is that if you make too much money, meaning in 2025, if you make more than $145,000 per year, you have to make that contribution on a Roth basis, meaning you have to do it with after tax money. What that's kind of what that will be interesting for is certain plans don't offer a Roth contribution. So in some ways, this could be read as it's going to basically mandate companies either add a Roth to their plan, or their elderly employees or older employees may not be able to contribute, which is never a good thing. So we'll see. We have a couple of years to see how that plays out. Sometimes those exceptions get grandfathered in, and it's only new plans, and we'll see how those things move forward. But there's some major changes there. Additionally, and not to be left out, IRAs are going to see an increase in catch-up contributions as well. They currently have about $1,000 catch-up contribution if you're over the age of 50. Starting in 2024, that number will be indexed to inflation. So that's kind of cool. We're no longer just waiting for the IRS to tell us what it will be. And finally, a really interesting change to workplace plans, um, and this affects most people 401ks or 403bs, is when you put money in, oftentimes your company gives you a match. And one of the great things about matches for employees is they get an additional amount of money, right? You put money in, you can automatically give yourself a raise. In years past, um, you were only able to get that match on what's considered a traditional or a pre-tax basis, meaning um, the company took a tax deduction for it initially. So when you pull that money out later on down the line, you have to pay taxes on it. There's a provision in this plan now that moving forward, employees at some point in time will be able to designate the match as a after-tax basis, meaning they can get Roth treatment for that. How this all plays out in payroll is going to be a very interesting thing for the accountants to figure out. But basically, an employer will be able to give you a match. They will be able to take a deduction in the year they give it to you, and then you will be able to claim it as a Roth basis, and you'll probably claim that match amount as income to you. So it's kind of a very interesting change, and will give a lot of benefits to employees and still preserve a lot of the benefits for the employers.
Yeah. Well, thanks for touching base on some of the, I wouldn't say basic, but maybe more of the general 2.0. I'd love to talk a little bit more about some of the interesting provisions that have come up with the Secure Act 2.0. Can you touch base on those as well?
Yeah. So one of the things that it's kind of commonplace now that a lot of plans have is called auto enrollment. So when a new employee comes on board, they're auto enrolled at a certain percentage. And that's an option today that a lot of plans have or presented. Starting in 2025, plans are going to require that. And that's kind of an interesting thing that the government's coming in and telling us as savers and as new employees, if there's a 401k plan, you're going to be automatically enrolled at 3% and you have to opt out. So that's a really cool benefit that's going to go in and become required. Another really interesting thing, and this is really, it may be a topic or a headline, is recent college graduates. They're coming out of college, they have a lot of college debt, and they struggle to save in their 401ks because maybe they have a lot of student debt. And additionally, they struggle because they don't have a emergency savings plan, and they don't have that emergency fund. And there's some provisions in this that will allow for new employees, or really any employee, but centered around more of your new employees, to establish both an emergency fund and receive a match into their 401k based on college loan payments. So, breaking that down, there's a provision that would potentially allow employees to save money into their 401k and have it almost go into like a savings account within their 401k that they would be able to pull out as emergency savings at different times. Now, how this all plays out and how this all gets taken care of, we've got a couple years to see, but it essentially would potentially allow employees to save about $2,500 a year into their 401k as an emergency savings plan. The second piece of that is I know a lot of us at different times have had student loan debt. There's provisions that will allow employees to provide proof of their student loan payments, and employers may be able to make or give their 401k match to these employees into their 401k plan um, using the payments that they're making on their student loans in place of saving to the 401k. So you may not get the full bang for your buck by saving in a 401k, but you're able to grow this retirement balance as you pay down your student loan debt. That's a really interesting provision. Finally, one of the most interesting ones is changes to 529 plans. And if you know anything about 529 plans listening, you're like, this makes absolutely no sense to go into a retirement bill. And on the surface, that's true because a 529 plan is a college savings plan or an educational savings plan. And essentially, you put money into a 529 plan, it grows tax deferred, and then can come out tax free for higher education expenses. And there's a list of different expenses that can be used. This provision updates what those 529 funds can be used for. In the event that 529 funds are available and the account has been open for 15 years, and let's say that let's say Raina that you have a child this year and we save money in a 529 plan for them, and then they go to college, they get a scholarship, they never end up using that. Um, Previously, there are some different things you could do with it, but they never used it for college education. Now, over a certain time period, you can move the money in a 529 plan to a Roth IRA for your child. So in this way, it doesn't have to be used for educational expenses anymore. It can be gone. It can be earmarked for that, and if it's not used, it can then be pushed into a environment that gives them a leg up for retirement savings. So it's kind of a really cool way to recycle unused educational funds, and we're kind of excited about the opportunities that might present itself with that moving forward.
Yeah, absolutely. Well, thanks so much on, providing this information about some general stuff, but also some really interesting things that have been added into the fold with the Secure Act. I just like to say thank you for everybody for listening along with us and wanting to learn more on your end. I ask if you want to read the article, if you want this in writing, you can go over to candorpath.com/blog and find Michael's article there. We'll probably also have it in our feed if you want to just search through here. But other than that, please, if you enjoyed this, share it on your Facebook with your friends. Keep everybody else in the know as well. Michael, thank you again for doing this with me and informing me because I always need it. But we appreciate you and the time you spend helping us gain our knowledge. So appreciate you. Thank you for listening along, everybody, and we hope you have a great day.